Live from the Bloomberg New Economy Forum here in Singapore, this is Insight with Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. Asian stocks finding some stability as investors weigh a sell-off in the world's biggest tech firms that's dragged global stocks to a one-month low. Nvidia's earnings out tomorrow, now taking on an even greater significance. We have a great lineup of corporate leaders here at the New Economy Forum sharing insights on the markets, AI, trade tensions, and much more. Over the next 2 hours, we speak with the CEOs of Fonterra, Nubank, the London Stock Exchange, and Hyundai Motor. Cautious trading across Asian markets today as investors brace for those critical earnings from Nvidia. JP Morgan Vice Chairman Daniel Pinto speaking on a Bloomberg panel in Johannesburg, warning that concerns over AI's rich valuations may trigger broader market losses.
It's possible there is probably a correction there. And that correction will also create a correction in the rest of the segments in the S&P and in the industry, because you are probably, in order to justify these valuations, you are considering a level of productivity that it will happen, but it may not happen as fast as the market is pricing.
Well, here at the Bloomberg New Economy Forum, we've had a more positive view today on the global sell-off from Bob Diamond, founding partner and CEO at Atlas Merchant Capital.
We've seen risk assets be repriced. In my sense, this is a healthy correction, not something that's turning into a bear market.
Let's bring in our Asia Markets Executive Editor, Paul Dobson. Well, two views. Which one is the right one?
We'll probably know by this time tomorrow, Haslinda, because we'll get the Nvidia results, and that will give us a lot more insight into exactly what the strength of the tech sector looks right now. I'm not massively surprised to hear that there's a bit more stability in Asia's markets today, because I think that when we went home yesterday, the markets were already looking about as rocky as they were over the past 24 hours, and the US session didn't really give us any particularly new information. The doubts are there, right? We know what the wobbles and the concerns are. Can the giant tech companies keep up this spending push that they're doing? Will the market tolerate it? Do they have a business model that's going to generate cash over time? And so we're really going to be keying into the narrative that we hear from Nvidia, from Jensen Huang. Can he sell us a story? Can the market continue to believe that beautiful growth story in AI that it's been buying into so far this year?
It is about Nvidia's numbers, but it's also about valuations as a whole, right? Mm-hmm. There's such a thing as too much risk and too much leverage. And we heard from Jamie Dimon saying, his words, shit happens.
Well, that's true. And he's been talking about the cockroaches as well and the over leverage in parts of the US markets, risky loans. We heard from Jeff Gundlach this week also talking about private credit as being an area for risk and for concern. And we see in some of the riskiest areas of the market where the retail traders have been bundling in that those are the ones that are really suffering at the moment, particularly Bitcoin and cryptocurrencies, of course. So yes, there's more worry and stress out there in global markets than there has been for quite a while. And yeah, bad things could happen. Won't repeat his language, but you get the idea. But on the other hand, there's this good news narrative as well. There is genuine growth. There is genuine promise for the future, and people love to buy into a story, and that's what we have with the AI narrative, and that's still keeping people hooked for that longer-term investment trend.
The earnings have been strong, right, Paul? Hang tight. Asian Markets Executive Editor Paul Dobson there. We're live, of course, here at the Bloomberg New Economy Forum in Singapore, where a panel on building a sustainable and resilient financial system is underway. Take a listen.
You've got to keep tracking that. And you have to make sure that the risk goes to places where the people who are going to bear it can actually sustain it.
Well, I knew that our panelists here would give us plenty of food for thought, and you both certainly have. Mark and Ravi, thank you very much. Ladies and gentlemen, please join me in thanking our panelists. Thank you, Mark. Thank you, Ravi. And while Mark and Ravi make their way off the stage, I have a brief announcement. First of all, of course, thanks everybody for your time and your attention. We're going to take a quick break. Not quite 30 minutes. I'd like you back here at 11:30 sharp. Outside, you'll find some refreshments. That's just outside the plenary hall. And a little further outside at the portico, Singapore House is serving some local delicacies that I encourage you to try. So once again, folks, please be back promptly at 11:30 for the next session in search of exceptionalism.
Our own Eric Sheska there on stage as we speak. Now, here's some other highlights from our guests so far at the Bloomberg New Economy Forum.
The fundamental problem with the US and China is an almost complete lack of strategic trust. And that means each side has to assume the worst of each other. And even if you're taking precautions, it's viewed as escalatory. Both sides have identified pain points. And I think what you've seen so far is not a strategic realignment or a sudden dawn of strategic trust. Is that both sides have decided they need time, they need a tactical pause whilst you get on with the real business.
What we're seeing more recently is Asia buys Asia. We're seeing China manufacture in the world as opposed to for the world. This Asia buys Asia trend is supported a lot of intra-Asia, the wider Asia, Middle East, supported a lot of trade within this region. It supported a lot of foreign direct investment in this region. It supported a lot of employment in this region. The dollar remains the major currency, right? That it will erode because there will be diversification, there will be usage of other currencies, there will be more and more usage of gold in reserve management. But it's not going to materially change the picture, certainly not in my career, probably not in my lifetime. This being said, payment trails, and this is kind of going back to what Lei was saying, payment trails will evolve.
Let's get to our next live guest here at the New Economy Forum. New Zealand's largest dairy cooperative has a global footprint across ingredients, food service and branded dairy, and Fonterra is now accelerating a $1 billion strategic investment aimed at dominating China's rapidly evolving food service sector. Joining us exclusively, and I think it is his first interview with Bloomberg, Miles Hurrell, CEO at Fonterra Co-operative Group. Miles, good to have you with us. Welcome to the show.
Thank you. Thanks for having me.
Talk about how China is an important market for you. I mean, you generate, 30% of your income from China. Why is it still important, given that it is an economy that's showing signs of, I guess, easing?
Yeah, well, it is about 30% of our book, but it has come off the heat of where it was maybe 2 or 3 years ago. But we're still seeing, significant people move into that middle class. We're seeing, the growth in disposable incomes for some of those high income earners, which is the market in which we play in. So we still see significant growth in that market, but also beyond that in places like Southeast Asia.
What will drive that growth in China? Consumption patterns, for instance.
Yeah, so you're seeing that the middle class. You're still seeing a growth in that middle class, urbanisation, so the growth of those tier 1 cities on the eastern seaboard. So you're still seeing a lot of growth in those markets for us. Of course, we haven't expanded too far west at this point in time. That's part of our growth play as well. But you've got to remember, we're a relatively small player in a very large economy, and so 95% of our products head into the international market. So, of course, we're not trying to tap into every consumer in China, trying to tap into those consumers that have the disposable income that can buy our products.
How about in terms of demand for dairy out of China, cream cheese? I mean, it is something that you're focusing on. You're investing millions of dollars in that.
Correct.
But that's due to a trend which may not even last. How are you looking at what's happening in China?
Yeah, and I think that the most important thing for us in this space is innovation. I mean, the market moves so quickly in China, as I'm sure you're aware. And so while cream cheese as a base product has a lot of usage, about making sure that we're front and centre of the consumers as they change their taste from tea macchiatos to coffee macchiatos and even beer macchiatos, which are being consumed as well. So how do we make sure that we're at the front of that when it comes to innovation?
Have you been surprised by the demand in for cream cheese and how people are consuming it right now? It's gone so big, it's gone viral on social media. Are you confident that that trend will persist?
Yes, we are, and also beyond the Chinese market. So we're starting to see that evolve more into Southeast Asia. So the traditional sort of bakery sector in Southeast Asia is moving, and I think that's part of the investments we're seeing of the Chinese markets move into that Southeast Asian. So we see growth in both China but also Southeast Asia.
Give us a sense of the numbers you're anticipating in terms of growth from Southeast Asia, from China.
Well, we're sort of in that 5 to 10% sort of growth range. But of course, the market moves quite quickly as well. And so, as I say, it's how do you have your people on the ground to understand where the market's moving, the innovation that's required to be at front and centre when consumers are looking for products like ours.
The other issue I'd like to bring up is your divestment, that sale to Lactalis. Why does it make sense? Because your foreign minister was pretty, adamant it was the wrong move.
Yeah, well, of course, that's his position. That didn't surprise me, quite frankly. But you've got to remember we're a cooperative and we're an extension of our farmers' farms. And what that means is recycling our capital the best way we see possible. And the higher returning products for us are in the business to business. That's the ingredients and it's the food service. And we believe recycling that capital back into further investment in B2B and also returning some of that to our shareholders is the right thing to do long term.
He did call it utter madness. It's like shooting yourself in the foot. How do you counter their argument? So
it comes back to the economics again. What is the right thing to do with a limited capital that you do have? And so we believe investing capital and where the higher returns are for us. The out-of-home consumption, the B2B, and also our advanced ingredients business is where we believe the value is, and therefore let's recycle that capital.
You talked about how you will reinvest $1 billion to counter the lost income. Is that really realistic? What needs to happen for that to happen?
Well, we truly believe it's realistic. In fact, we've announced already about $500 million of recent investments, whether that be more UHT cream, whether it be cream cheese, whether it be new butter capacity. So we've already, and also advanced proteins that go into medical nutrition inside North America. So we truly believe that 500 is realistic, and it's a market that continues to grow, and for us that's important.
One of the key focus as well is what the farmers would do with the amount that's distributed to them. There's a sense that the RBNZ did say that they are likely to pay down debt. Is there any suggestions from the farmers that that's the way they're going?
Well, certainly, on-farm debt has risen in recent times, and so, on-farm inflation, on-farm costs have gone up quite significantly. There's a bit of deferred maintenance, deferred capital that farmers haven't been able to invest in. So I'd see a combination of maybe paying down some debt, investing some capital on their own farm, but also, it's been a tough few years for our farmers in New Zealand, so I suspect some will also look to enjoy some of that. It is an investment they've made in the cooperative. It is a capital return, of course, we've got to remember that. And so I think it'll be a combination of all those things.
Right. And what are you seeing in terms of their balance sheet? Is there anything to be worried about?
Certainly not. So the medium to long-term position of the dairy industry globally is still in great shape. We've seen a bit of uncertainty right now, a bit more milk that's come out of places like North America and Europe. But over that medium to long term, we still see the long-term position of the dairy industry very strong. And so farmers' balance sheets are in pretty good shape from where they have been historically. And I see this capital injection that they're going to see the capital return will go some way to strengthening that further as well, investing for the long term.
Miles, it's also about dairy prices, and it's not looking pretty. When you take a look at what's happened overnight, it dropped about 3% in terms of its auction. That will have implications on prices going forward. With the kind of production you're doing, excess production you're doing in New Zealand, will that weigh on prices further?
Well, yes, it was a bit disappointing to see that reduction come through last night. It's on the back of probably 4 or 5 reductions in relatively short order. So we are watching that closely, and I think most of that comes back to the increased milk we've seen out of North America, increased milk we've seen out of Europe. We'll see our way through those. I think there's a couple of things that have gone against us in the near term, but we're still confident that the numbers we're talking about, a forecast of $10 a kilogram of milk solids, is still right up there with our long-term, well above the long-term averages. So still feel confident about that. We just need to watch it in the near term.
As you look to grow the business, there are lots of uncertainties out there. We hear from the panels that are happening here at the New Economy Forum, slowing China, AI, US-China tensions. I mean, what keeps you up at night, and what is the biggest risk for your business right now?
Yeah, so I guess it is important to be at places like this. I mean, 95% of our business is in the international market. We're dealing with volatility, the unprecedented things that are going on as we're hearing today. So it's about having your finger on the pulse the best you can as to what's coming next. But we are an export nation. We've come up with these things for over 152 years old as an organisation now. So there's a couple of world wars that have been thrown in there, a few depressions along the way. So we know how to manage these things as tough as they are.
So no risk?
Oh, no, certainly risk. Don't worry about that.
What's the biggest risk?
Oh, I mean, I guess the volatility we see in the market and the tariffs that are played out, the tariff situation in the US, and while that's impacting our business in the US to a small extent, it's the uncertainty that leaves in the minds of our buyers globally. So they're the things that I guess keep me up. But at the same time, how do you make sure your own organisation's resilient as it can be? keep an eye on your costs, look for new markets, look for new customers, do the basics, do the fundamentals well, puts you in the right position to take advantage for the long term.
Keep an eye on the demand for butter and dairy, right?
Yeah, absolutely
Miles,
right.
thanks so much for your time today. Miles Hurrell, CEO at Fonterra Co-operative Group. Well, much more ahead, coming to you from the Bloomberg New Economy Forum. Nubank CEO David Vélez will be joining us next to discuss growth in digital financial services. The London Stock Exchange chief David Schwimmer will be weighing in on concerns about global market valuations, and Hyundai CEO will be talking to us about their business strategy in the US amid shifting trade tensions. Plenty more ahead. Keep it here with us. This is Bloomberg. Welcome back to the Bloomberg New Economy Forum, where everybody's mulling over all the big issues, including US, China, AI, and of course the risks in the market. Joining us exclusively now, David Vélez, Chairman, CEO, and co-founder at Nubank. It's a digital financial services platform serving around 127 million customers across Brazil, Mexico, and Colombia. It's now one of the most valuable Brazilian companies after going public in New York almost 4 years ago. Ain't too shabby. David, good to have you with us.
Thank you for the invite.
You know, we've been talking about all the risks. We're talking about all the concerns of the markets, the fears that perhaps valuations are so high. What's the key takeaway here from all the angst and the edge that investors are feeling?
I mean, certainly there's a sense of frothiness in investing, specifically driven by everything that's happening in AI. But nobody really knows, because this is such a fundamental different technology that is changing all markets and all sectors. It's a revolution. It's similar to the Industrial Revolution. It's a revolution similar to the Internet Revolution. There is certainly frothiness in some areas. There are some companies that are going to succeed. There are some companies that are not going to succeed. So I think right now we look at all this volatility and it's hard to really know what's going to work out and what's not. But the trend is very powerful. And so ultimately, I think for companies like us, you have to invest behind. You have to continue operating, continue moving forward, be on the lookout for risk. There is a lot of risk. But there's a lot of opportunity coming in with that risk.
Where are the opportunities? How are you investing? Where are you investing?
In our situation, we see financial services globally. Financial services is still the single largest profit pool in the world from an industry that hasn't really been reinvented. If you look at financial services today, 90% of it is still dominated by the big incumbent banks that have controlled this industry for decades. And all industries have been reinvented by technology. Financial services still hasn't. So our thesis in 2013 when we began is that the future of financial services is for consumer-obsessed digital banks. We began with that thesis in Latin America, Brazil, Mexico, and Colombia. We think over the next 10, 20 years, the leading financial services companies in the world are going to be fully digital banks, technology companies, and that is the opportunity. And some of the trends like AI will only be enablers of that growth.
And yet, your focus has been Latin America. I mean, if you take a look at Southeast Asia, Asia as a whole, 1 billion people in India. Why are you not here in a bigger way?
Well, we have to focus a little bit. And, Brazil, Mexico, Colombia, Latin America is a 650 million population. That's where we began. That's where we saw the big banking concentration. About 5 banks own 85% of the assets in Brazil, in Mexico, and Colombia. Actually, not that different from Southeast Asia or from Africa. You see a lot of similarities across all of these different countries. Eventually, I think we're going to be able to see this trend, these thesis playing out in different parts around the world. We made an investment in a company called Time, which is one of the leading digital banks in South Africa and the Philippines. And that's one way for us to start getting smarter about the opportunities that Southeast Asia has. But for now, we're kind of focusing slowly in expanding this model.
What have you seen so far from that investment in Time? And are you intending to replicate it elsewhere in Southeast Asia?
So we've seen a lot of similarities actually with Latin America. Basically, you've seen a lot of these countries around the world, you have a bank population that is being served by big incumbent banks, generally oligopolies. 5, 6 banks owning the majority of the financial services space. Whenever you see oligopolies, you're going to see lack of access, you're going to see very high fees, interest rates, poor service. So for that bank customer, a fully digital banking model can provide better products at lower cost, our cost structure enables us to serve at a much lower cost. So, and so for the bank population, you can serve a better product. Then you have the large unbanked population. In Latin America, over 250 million people have no access to banking. Around the world, something like 3-4 billion people have still no access to banking. You need a very efficient model to get to that, and that's the digital banking model. So we actually see a lot of similarities between a country like the Philippines or Mexico or Brazil, as in a model that can provide a product for both banked and unbanked, could be the winning model over a 10, 20-year horizon. These are models that are very local in nature, it's very regulated, you need licenses, so it's harder to internationalize. But if you have a model and a playbook that start working, you can actually do it.
What is the strategy? If you take a look at Southeast Asia, I think it's the same in Latin America, where there's still a huge potential because there's a lot of people who are still unbanked. Yet there's certain pockets of the sector which is already kind of close to saturation. How do you balance that? How do you square that?
Yeah. So yeah, you have the bank customers that are very well served, but they're paying very high. A lot of them are paying extremely high fees because they're ultimately funding a physical banking infrastructure that is very costly. People are still paying for banking branches that they actually don't want to use. And big banks maintain those banking branches. For the majority of financial services, you don't need all that banking infrastructure, right? It's a little bit like the Blockbuster, when you used to go to Blockbuster to get a VHS and then suddenly Netflix came. The same thing is happening in financial services. But then, yeah, the opportunities in our 4 billion customers around the world that have no access to banking services, they have no access to credit. So digital banking infrastructure and credit capabilities will enable to bring 3-4 billion people to the global economy. We'll be able to create huge formalization around the world. And that's one of the biggest opportunities that we see. It requires a lot of capabilities, data, to be able to do credit for customers that have been unbanked. It requires a lot of patience, a lot of infrastructure. But we've been able to show that, at least in Latin America so far, that there is a model here that can be replicated very effectively.
Speaking of credit, gives me a good segue to private credit. We heard from Jamie Dimon, of course, talking about, concerns in the private credit space. When it is a $3 trillion market, any signs of, I guess, an unwinding is a great concern, or is that overblown, you think?
I think it's hard to say. I wouldn't have a very strong point of view. It's a very large market. There is some frothiness in the private sector market.
Just some?
There is some, but it's also a very large market. So ultimately, it's hard to know exactly how much it is. Ultimately, though, investors are investing in these assets, and they are expected to do their own due diligence. So it is always a little risky when it's completely unregulated, when it's not an area that really has regulators forcing certain disclosures. But these are very sophisticated investors that are making these investments ultimately. So I'm sure there'll be bad investments in that area. There'll be good investments in the area, and we'll see ultimately where that lies. Of
course, retail money is increasingly getting into the private space as well. Therein lies the issue.
That's right, yeah. In our case, we're fully regulated. We have banking licenses. We provide credit, but we always operated in the fully regulated aspect of the industry. There are benefits and costs to that, but ultimately for a model makes a ton of sense.
Great to have you with us. Thanks for joining us. We're coming to you from the Bloomberg New Economy Forum. Plenty more ahead. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight live from the Bloomberg New Economy Forum in my city, Singapore. Let's get straight to our next guest. Joining us exclusively, David Schwimmer, CEO of the London Stock Exchange Group. David, good to have you with us.
Great to be here.
Conversations around, of course, the perhaps unraveling of the stock market. What do you make of, the sell-off we've seen in recent days?
I think we're seeing some volatility. We're seeing some uncertainty. Uncertainty is probably the big theme. And if you look across markets around the world, there are questions about the levels of debt. There are questions about inflation. There are questions about AI. Is it a bubble? Is it not a bubble? I think that this kind of environment where there are that level of uncertainty, we see a lot of activity in the markets.
You welcome the correction?
Well, I'm not sure we're in a correction yet. I think there's always a healthy dynamic in the markets when investors take a step back and they look at what they're doing. I think there's been a lot of discussion on valuations getting stretched, a lot of discussion on whether some of the different sectors in the market, AI or others, will generate value or create some value destruction. I think it's healthy for people to be thinking about that and helpful. That's what makes a market.
Is there froth? What are you thinking about those stretch valuations? Are they justified?
I think what we'll see is that you're going to have some companies that will end up doing well, and you'll have some companies that will not. I mean, it's and when we see these kinds of frothy valuations going into new sectors or new innovation, sometimes it ends up well, sometimes there's real value destruction. I think it'll be a mixed bag. But
there's a lot of talk about how there's too much risk, too much leverage, and perhaps it is time to reassess, how money is deployed, especially with retail investors pumping in the money right there. Is there a sense that perhaps investors are underpricing the risk right now?
I think there is a case to be made that markets are underpricing a lot of the risks that are going on right now. And then that kind of underpricing, if you will, is supported by plentiful liquidity in the markets that we have seen really over the last 5-10 years. A lot of that pumped into the markets with government action. So it's hard to know. There's also a positive case to be made in a number of areas. Are valuations stretched, or are we on the cusp of a massive new productivity boom? I think it's going to end up being a little bit of each, but it's hard to know.
We know that that's not the only concern. The other concern is also to do with the private credit space in particular. The likes of Jamie Dimon have called out how cockroaches have appeared, and they have. Is that an area to be concerned about, or is there an overblown kind of fear that we're seeing at this time?
I think it is just another dynamic in the market. And when you have, whether it's private credit or private equity, I think the fundamental issue or the fundamental driver of uncertainty is that by definition there's a lack of transparency. And transparency is helpful in terms of having sort of a public markets. You can have a daily mark to market. Sometimes those valuations in the public markets can get a little bit out of whack as well. So that's not a cure-all. But that kind of daily transparency is helpful in terms of reducing some of the uncertainty. When you have this significant expansion in private credit, a little bit of the blockage in the private equity markets, that adds to, it's another risk in the market. It's another risk in the system.
We talk about liquidity, a lot of money sloshing around, and that's supporting the valuations that we're seeing right now. But we're not really seeing that flowing to you, to the UK, the like of IPOs. How do you explain that?
Well, I wouldn't say it's specifically a UK thing. In other words, if you look on a global basis, we have had a slower period with respect to IPOs over the last few years. IPO market windows open and close. It was a pretty tightly closed window in a lot of markets for a couple years. The US saw its market opening earlier this year. The UK has seen its IPO market open really since the beginning of October. We've had 7 IPOs in the last 7 weeks. And the pipeline's looking good. So I think that market, the IPO window will continue to open and shut depending on what's going on.
So do you expect the pace to accelerate? Because, you said that it is a global trend. It's not really. If you take a look at the IPO market in India, it's thriving. The IPO market in Hong Kong is thriving. But it's not where you are.
It's thriving now. But a few months ago, or last year, China was seen as uninvestable. And so these are cyclical dynamics. I think in the UK you have seen the IPO market pick up really in the last couple months, and the pipeline's looking very healthy.
What might pull back, the interest from companies wanting to IPO from Asia, from the US?
Specifically into the UK?
Yes.
I think that the UK, one of the great strengths of the London Stock Exchange and the UK market is it's the most international financial center and the most international capital market in the world, significantly more so than the U.S., which frankly is more focused on U.S. stories. Hong Kong tends to be more of a gateway for China and have companies having a China nexus. But the UK...
But it's global competition, David. I mean, like every single market, no matter what region, is trying to draw the IPOs to their market.
Sure, but the different markets have different strengths, and one of the great strengths of the UK is that international positioning, and that we have investors and companies in London from all over the world. Something like 40% of capital invested in London-listed companies comes from the US. We have capital coming from Europe. We have capital coming from the Middle East and Asia. Whereas in other markets around the world, it tends to be much more regionally concentrated capital.
Is the weakness in the UK economy a consideration for companies wanting to IPO?
I think whenever companies are thinking about IPOing, they're looking at the macroeconomic factors. If they have exposure to a particular country or to a particular region, of course they prefer to IPO in an environment that is looking like it has a strong growth trajectory ahead. And equities, by definition, are forward-looking. So I think a strong, healthy economy is helpful for companies that are looking to list.
Could the budget that's coming be a game changer in terms of sentiment towards IPOing in the UK?
I think there's obviously been a lot of focus and anticipation around what the budget will hold for the UK. I think the important thing for the UK from an economic perspective is to make sure that its fiscal house is in order, to have the breathing room for investment, both public sector and private sector investment. I think there are clearly some fiscal challenges. There's some political challenges, and I hope that the government can put a budget in place that addresses those kinds of needs.
AI, of course, is a big theme for exchanges. You know, AI, data. How do you see that contributing to the business?
So for our business, AI is a big opportunity for us. So roughly 50% of our business comes from our data and analytics. And we are seeing significant opportunities in terms of both embedding AI in our workflow, but also in providing our data into a lot of these large language models and cloud providers that are enabling more and more of this AI functionality. So that's a very significant opportunity for us. We're also using it in our internal operations, whether that's customer service, whether it's how we ingest data and use more AI and automation to do that. So big opportunity for us that we're seing really across the business.
So how are you invested, and what's your AI strategy basically to benefit more from the technology?
So it's really those three areas. It's embedding AI in our product and what we refer to as transformational product. It's our trusted data, where we're providing our data. We have partnerships with Microsoft, with Databricks, with Anthropic, and a number of others in terms of embedding our data, which is trusted and in many ways industry standard on a global basis, embedding that data into these models. And then the third leg of our strategy is what we refer to as intelligent enterprise, making AI functionality a core embedded part of how we serve our customers, how we drive our operations, how we run our analytics, and it's having a significant impact in terms of improving our efficiency.
Why do you think your strategy is not sitting well with your investors? When you take a look at your stock price, it's not doing as well as your competitors, for instance. It did get a lift from your earnings, but it's back to where it was before.
I think there has been a significant question or a narrative ongoing in the markets as to whether AI is going to be a benefit or a challenge to a number of companies in the information services space. When I look at the opportunity that we have and the opportunity that we see going forward, and a number of our investors really understand this opportunity, I think it's going to be a great trajectory for us going forward. The market will do what it will do, and market goes up and down. I think there's a lot of misunderstanding and uncertainty associated with the, I'll say, disruption potential that AI has. But in terms of LSEG's positioning, I think we're in a great position. But it's about
building investor value. How are you doing that?
In terms of providing our data into all of the AI driven models, if you look at the consumption of data that we're seeing now, in part driven by the continued or the growing use of AI. That plays right into our strengths because we have the best data in the world for the financial sector. We have a huge amount of it. Just to put that in context, the common crawler metric of what the size of the internet is, which most of the public LLM models have been trained on, it's about 10 petabytes. We at LSEG have 33 petabytes. I mean, it's an enormous amount. Humans can't consume that data. Models can. The key point is for the models to consume that data in a way where the data is structured so that it is accurate in the models. And that's what we provide in this environment with all of our partners who are using our data for AI. So that's a huge opportunity that's just getting started now. We also have, in terms of our workflow, in terms of our analytics, embedded AI into that functionality. So that in the same way that Microsoft talks about getting 40% greater efficiency with GitHub Copilot, we have greater efficiency with our financial analytics because we've embedded AI in that. So lots of opportunity there as well.
David, you recently addressed leadership changes. I'm wondering whether you did that on the back of pressure from investors or analysts. I mean, what's the thinking behind that?
So LSEG's been going through a significant transformation over the last few years. And we are now one of the world's leading financial information providers as well as market infrastructure providers. The transformation that we have gone through doesn't just happen. In other words, we have, in a number of areas, brought in great new leadership to drive that transformation. We're a very different company from what we were certainly 5 years ago, but let alone even 2-3 years ago. So part of that has been bringing in great new leadership.
All right, David. Thank you for joining us today on Insight. David Schwimmer, CEO at London Stock Exchange Group. Now, on stage at the Bloomberg New Economy is a panel on how the new global investment opportunities are for investors. This era of American exceptionalism may be drawing to a close. Bloomberg's Eric Schatzka is currently moderating a discussion with Temasek CEO Dylan Pillay, as well as Algebris Investments David Serra and Natixis CEO Philippe Sedbon. Let's take a listen.
My only remark on that is I think it would be better for any financial market in the world that US economy and US financial markets go well and continue to go well. Second remark is based on what you said. I think if we observed and we lived in this decoupling between economy and performance of the financial assets, this is clearly not due to, let's say, this is of course part due to the innovation, productivity, blah, 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 but this is mainly due to the interest rates environment. After the financial crisis in 2008, 2009, the quantitative easing, which has been implemented and executed by all the central banks, and in particular with the Fed, which is the central bank of the world. We like it, we do not like it. This is a fact. This is the central bank of the world. And it has been just incredible. And the financial markets flew thanks to this quantitative easing performed everywhere in the world, and in particular in the US. And just my last remark on that, it seems because of inflation, because of, let's say, maybe also because of the first month of the second run of the President Trump, this period is maybe over. This period of zero interest rates around the world is over. And it changed dramatically the way of making investments in the future.
Dylan.
So Eric, I think it's a question of how we define U.S. exceptionalism. You can define it by reference to financial markets or more broadly as to what allows the U.S. to perform well in the financial markets. I think there are 5 factors that go into U.S. exceptionalism. The first is the breadth and depth of the capital markets, which is very significant. I would say U.S. exceptionalism in capital markets remains where it is today. 65% of equity is U.S. dollar-denominated stocks. You've got 60% foreign currency debt is US dollar denominated, and then forex flows 88%. So a lot of it is driven also by capital markets as well. So that's one level to look at. The second is innovation. US exceptionalism also drives on the back of innovation, and that's science. That's the universities they have, that's the ability to attract talent to come in, all of which right now may be under a little bit of stress, no doubt. The third is US military power, which gives them that sort of hegemonic ability to push itself beyond its boundaries. The fourth, I would say, is institutions in the US and the rule of law, which also is coming under a little bit of stress right now. And the fifth, of course, is the reserve currency, which now accounts for about 58% of central bank reserves and is used for transactional flows almost everywhere. So when you look at these five factors, US exceptionalism for the time being doesn't look as though it's going to be at risk. But for all of these five factors, you do have things that could cause a little bit of fraying, and that could cause US exceptionalism to be at risk if you think over the longer term.
The fundamental problem with the US and China is an almost complete lack of strategic trust. And that means each side has to assume the worst of each other. And even if you're taking precautions, it's viewed as escalatory. Both sides have identified pain points. And I think what you've seen so far is not a strategic realignment or sudden dawn of strategic trust. Is that both sides have decided they need time, they need a tactical pause whilst you get on with the real business.
And that was Singapore Minister for Foreign Affairs, Vivian Balakrishnan, speaking earlier with Stephanie Flanders, Bloomberg News Head of Economics and Government. She joins us now. It does seem like that trust deficit within the US and China will persist and they will remain at loggerheads at some point.
Yeah, I mean, I think what was interesting about the conversation was, we're taking stock after this deal rapprochement, as he described it, as a tactical pause, but in the battle between the US and China, at least on the trade front. And he'd obviously been present at the ASEAN meeting and the APEC meetings where those negotiations were completed. And one of the sort of odd things about that is that China had ended up actually in a relatively better position vis-à-vis the US, lower trade barriers than many of the other countries around the table that had thought they were going to be the alternative to China in US industrial manufacturing and sourcing goods for a US supply chain. So I was trying to get a sense from him whether he thought that was a permanent shift, that it was we were no longer on a path to decoupling because the US seemed to be having to be quite relatively favorable to China. But as you heard, he feels that that's really impossible given the trust deficit, and that's the long-term path. I do think it's strange, though. It's this idea of, a couple, they're going to get divorced in 10 years' time, but they're going to live together for 10 years right up until that time.
But it is out of necessity, right? I mean, China has more leverage than the US thought before, and that has a lot to do with critical minerals, with rare earths. Until that happens, until the US can secure its own alternative sources, then they have to play ball.
Yeah, and I think what's interesting is what a shock that seems to have been to the administration that China was willing to play that card so aggressively. I mean, they have been planning really since the first Trump administration and the beginning of the trade hostilities, which continued under the Biden administration. There's a very consistent policy shift. The Chinese had prepared for how they were going to deploy this weapon. And I think we shouldn't forget that we still have these licenses. There's a bit of lack of clarity about what that deal actually was that was done with the US, the year pause. All of these companies all over the world are still having to fill out very complicated forms explaining exactly how important these things are to their supply chain and how few alternatives they have. I think the Chinese are not just wielding this weapon, but using it to get a massive informational advantage.
You talk about that rapprochement. That's going to go on for just some time. In the end, I guess, game would still be a strategic decoupling between the two.
Yes, although I think what is interesting about this Trump administration, again, is you had a very consistent path between the first Trump administration and the Biden administration, and about export controls, not allowing the Chinese to have some of these very sophisticated computer chips. There was a consistency there, and then a lot of the elements of that architecture that things have been taken away or deals have been done that are inconsistent with it. The US has said it's now willing to give some of those chips to, or sell some of those chips to China and give these better trade deals. So I think for allies who felt they were under pressure before to choose between the US and China, well, the US is sending much more mixed messages now, but it's still, if the US is also imposing tariffs on them, so it's still a very uncomfortable place for places like Singapore.
Yes, and it does seem like in the end, China's the winner.
Well, but China's also destabilizing the system, right, with its push for exports. It's continued to double down. It's the only country that's grown its exports this year, despite having a fall in exports to the US. More exports are going to other countries. That cannot fail but affect Southeast Asian economies that are also trying to reorient their trade away from the US. China is still a source of economic instability, even as it says it's going to be the underwriter of the global system.
But it is a China that's slowing down, still having issues with its property market. And economies like Singapore can't afford that.
Yeah, no, I think, well, there's one thing I also wanted to get into with him, because I think this question of overcapacity, and he raised it later in the conversation. We have a China that we keep predicting, we talk about decoupling, but we've also predicted that China would move on a more consumption-led growth path. And at every turn, President Xi Jinping has said, nope, that's not what I want. I want to continue with this very industrialized approach to growth. And that has ramifications for all of these trading partners who are now competing over that same pie.
What are you looking out for in the upcoming conversations? Is there one particular theme that you are paying particular attention to?
I think AI is obviously one of those things. We spent a lot of time talking about trade this year, but AI has increasingly encroached on the conversation. If you look at the US economy and the global economy, I think that AI investments have been a massive shock absorber. It's one of the reasons it's hard to spot sometimes the impact of tariffs, because there's so much else going on and there's enormous investments in AI sloshing through the system. I guess the question hanging over this forum is whether it will be a source of shocks next year if all of the doomsters are right and that we are looking at potentially a bursting of the bubble.
Stephanie, great perspective. Thank you for joining us. Bloomberg Stephanie Flinder, still to come on Insight. Hyundai CEO José Muñoz will be joining us exclusively here at the New Economy Forum to discuss their EV push and the outlook for operations in the U.S. after those September rates on their Georgia battery plant. Much more ahead. Keep it here with us. This is Bloomberg.
Back, you're watching Insight. I'm Paul Allen in Sydney. Let's take a check of how the market's tracking at the moment. We are seeing some cautious gains in Asian stocks today, and that's despite sharp losses on Wall Street earlier. That's as investors brace for those critical earnings from Nvidia. A sell-off in the world's biggest tech firms has dragged global stocks down to a one-month low. Traders questioning whether lofty valuations in tech are justified. Anyway, let's get straight back to the Bloomberg New Economy Forum in Singapore, where my colleague Sherry Ann standing by with our next guest. Sherry.
Paul, thanks for that. Of course, a lot of the conversations here surrounding trade and also the geopolitical fragmentation that we continue to see around the world. And one of those companies that's really navigating this changing landscape is Hyundai Motor. Joining me now is the chairman and CEO, José Muñoz. Great to have you with us.
Thank you for having us, Sherry.
The landscape right now is so complex. What's top of mind for Hyundai at a time when we are, of course, dealing with changing tariff levels around the world and Hyundai is trying to expand its foothold?
Well, the most important that I have always on my mind is the customers. No matter what happens with the regulation, no matter what happens with the changes in the political environment and the conflicts, and everything else, customer is the most important. So we will always respond with the best for our customers.
And some of the new innovations that you're also bringing forth has been around artificial intelligence, big investments with Nvidia as well. Tell us a little bit about why that fits into the Hyundai strategy.
Perfect. So as most people know, Hyundai is now the third largest global OEM. And we are the second largest on profit. And one of the competitive advantages that we have is the vertical integration, which goes from producing steel to logistics to assembling the vehicles, having suppliers, distributing them, doing everything, right? Well, of course, as part of the latest and greatest technology, AI, and then the future of mobility, the autonomous driving, which can be utilized in different areas of the business, including robotics, all these elements are integrated, and then they help us improve our fundamentals, which are about having better productivity, having better quality, and lower cost to compete, no matter what tariffs you have, etc.
Are you going to be producing your own in-house chips as well?
Well, we already produce some, but as you know, we made a nice deal recently, announced like $3 billion investment with Nvidia to ensure that we have the latest and greatest capabilities when it comes to enhancing our capabilities. How? For example, with robotics. So we see the future of manufacturing by bringing robotics into our plants. So, for example, here in Singapore, we are the only OEM, so we have a factory called HMGX, which is trying to implement the so-called concept of dark factory, which means you don't need people to operate. It's like autonomous manufacturing. You have autonomous driving, and then this is autonomous manufacturing. To be able to implement that, you need to deploy your capabilities in robotics. As you know, our company controls Boston Dynamics, and we are trying to produce our robots in our factories and utilize them in the lines to try to support the capabilities of the humans. So we don't want the humans to lose their jobs. We want to capitalize and maximize the human potential by giving them these robots.
I was going to say, I mean, artificial intelligence and incorporating that into your business also means potentially changing in jobs and skill sets as well. Do you expect that efficiency to actually lead to losses, job losses as well?
No, as mentioned, I think what is happening is that we are developing more capabilities, and then we are trying to maximize the power of the humans who are working in the factories. So there are jobs that they couldn't do by themselves, now they can do, and then we require more technical engineering type of jobs versus manual type of jobs in the plants.
When it comes to operating those factories, strategic localization is key here, right? What's driving those moves and those decisions that you're making right now?
Well, it is very interesting, right? Because as you see changes in regulation, like the tariffs in the United States, you have to quickly react to try to minimize the impact and be more competitive. But we were already on a roll when it comes to announcing big investments in the United States. So we have announced $26 billion in the next 4 years versus $20.5 billion in the last 40 years in the States in a steel factory, also in assembly of vehicles and others, right? But also in Korea, last week we announced 125 trillion Korean won, which is about $86 billion in this midterm plan, meaning through to 2030, because we want to be the best at all the latest and greatest in technology, like on chips, like in robotics, like AI, like in hydrogen technology.
When it comes to the investments into the United States, we heard that some of the workers that actually were affected by the Georgia raid would be suing ICE. What is the role that Hyundai is playing now?
Well, that was an unfortunate event that happened in actually a battery plant from LG, where we are shareholders. And then always trying to be positive. What happened was a very positive reaction by the federal government and also by the state, which I think is going to help fix this issue of the visas once and for all. I think it was clear for everybody that all the workers that were there, they were legal workers, and then the construction of the factory has continued. In fact, a lot of those people that left the country, they're coming back step by step, and we continue the operation. A lot of questions. What are you going to do? Well, we don't make decisions based on the short term. This is a mid to long term decision on where we want to localize to be stronger, and it was an opportunity that we already had identified. In fact, in March, when we saw the president announcing the tariffs during the Liberation Day, we were celebrating the grand opening of our brand new plant in Savannah, Georgia. Right, so we were not waiting for tariffs or no tariffs. We want to grow in America. It's our largest market, and then we saw this opportunity of localization.
And does it give you more long-term confidence that the White House reached out personally after the raid?
Yeah, absolutely. I think the White House, I think, is very happy with the level of commitment of our company, the mid to long-term investment, the thousands of jobs, right? So we have roughly 190,000 workers in Tier 1 and Tier N suppliers in America. We are adding around 25,000 more. When these raids were happening, we were announcing additional investments of around $2.7 billion, 3,000 more employees, and 200,000 more capacity. So I think, obviously, the government likes what we're doing. There's a very strong commitment to the U.S.
What's happening with the visa issue, though?
Well, we found together a very, very good solution. We put together a group of people working from the State Department and also from the Korean authorities and the representatives of the different companies, which we are helping to coordinate. And we're finding the right type of visa to ensure that the technical workers that actually are not available in the U.S. can go to the States, do their job, and then come back. So that's basically the positive side of this, that I think we found a good solution not only for our company, but for all companies that are investing in America.
Do Hyundai employees feel that way? Because I was speaking to President Lee Jae-myung recently, and he mentioned how the workers themselves may be a bit anxious about going to work in the U.S.
Well, it's obvious that it's normal that people may feel some anxiety, but I think we just need to reassure them, we need to advise them. The U.S. Embassy in Korea has supported us a lot, the Korean government has supported us a lot, and also the State Department in the States have supported us. So, and I think as they will see that people are coming, that nothing happens, we advise them, we help them, so I think everything is going to be okay.
How important is the U.S. market to you, given, of course, that we are seeing some of those U.S. subsidies expiring, especially when it comes to EVs sector?
Right. So the U.S. market is one of the most important, if not the most important. It's a very important market for many reasons, right? And we've been doing quite well. We've been making good progress, advancing, selling. We are the second largest seller of EVs as a group, and we have become a real economic power. So definitely we want to do well. And then, you know, on the one side, you may say, hey, there are some more barriers, but then the way to address that is to localize. So you have to invest, you localize, then you produce more, and then the tariffs don't impact you, right? And then we can also export to third markets. But what is very important is that our company, at the same time as it's decided to invest in America and other markets, by the way, also investing in Korea. And then we announced during the Investor Day in New York, which was the first time an Investor Day took place outside of Korea and by a foreign CEO, myself, that we were making plans to increase our capacity by 1.2 million globally. So it's not only the U.S., but the U.S. mainly. Korea, for example, Ulsan plant I was visiting recently, we're going to have the state-of-the-art EV factory, right, and then 200,000 capacity for EV cars. I think it's a kind of a global expansion. We are a tech company that happen to be in the automotive business, and we're growing everywhere.
That's interesting. I want to get to the next generation technologies, but when it comes to the imports into the United States, how big of an impact will it be that, at least when it comes to Japanese car makers, you've lost a competitive edge the Korean car makers had, the 2.5% advantage pre-President Trump?
Well, I always say, you know, this is a supply-demand balance, right? And then you have to play with your best equipment, which is the product. So that's why it all comes down to how good your products are. So we are investing on EV, on hybrid, on EREV, on fuel cell EV. a great design, great quality, the best warranty in the market, competitive prices, good financing conditions. You know, this is really the name of the game. If you produce those vehicles with very good quality, you produce them domestically, you can compete with anybody. So, in fact, you look in the market, there are differences between different OEMs in the same segment of up to 10% or even more. So 2.5, 3, 4, you know, you have to work with them. At the same time, on the cost side, you need to make your best efforts. You need to ensure that you don't over-invest in terms of the differentiation between platforms. So, for example, we have 84% of our cars are built on 3 platforms. So we're very commonized, right? And then our battery technology, okay, very modular, so that you can be efficient. The equipment, the technology, etc. Not to mention what is coming in the future with the SDV, the software-defined vehicles, which allows you much less cables, much less hardware. The investment is lower, then you can update the technology, the vehicles, as you update your software. You know, these are the things that you have to do fundamentally right. And in parallel, you have to localize. I mean, there is no other way around.
Yeah, the localization, how much of that is also an India play, whether it's targeting the market or also exporting from India?
Well, exactly. So also recently I was in Mumbai having the CEO Investor Day and then presenting our midterm plan, right? It was really fantastic, and the company has been recognized for the roughly $5 billion investment to introduce 26 new products in the market. 11 are going to be first time ever. We're going to enter into the MPV segment. We're going to enter into the body and frame vehicles to be able to compete with the local producers. We want to achieve 15% market share, maintain our second position in the market, and be the #1 exporters from India. So you do all this right with competitive costs in the new factory that we just opened last month in Pune. You know, and then all markets want to get access to those cars. So Latin America, for example, it is the second largest destination of cars. Middle East, 50% of those cars. Latin America, more than 40%, right? They love the vehicles, the design, the competitiveness, etc. So if you do the fundamentals right, you localize, you invest, I mean, is the only solution. Easy to say, more difficult to do.
I know. When do you overtake Suzuki in India?
We don't have, we are not obsessed with overtaking anybody. So we became #3, just doing the right thing, right? And then we are #2 in India. We're very happy being #2 because it's better to be #2 and having double-digit profits than potentially being #1 and then not being so profitable, right? So we just want to do the right thing for the customers, for the shareholders, for our partners, the dealers, and other partners. And I think that's the way to go.
Next generation technologies, you're also collaborating with Waymo and other companies as well.
Absolutely. So last week we announced, we showed our first Ioniq 5 with the Waymo autonomous driving technology. It was fantastic. And then next year we're going to start producing several thousand cars with Waymo, and then from there onwards we're going to continue to produce for hopefully many years to go. It's a new market. We're pioneers. I think our technology, our vehicles are in high demand for the companies that are developing this technology. And then we believe that Waymo are the most advanced and great partners, and then we work very well on collaboration.
When it comes to high-tech and advanced technologies, whether it's autonomous driving or whether it's like artificial intelligence, we're seeing this incredible fragmentation and divergence because of the US-China rivalry. How does Hyundai see that?
Well, we compete in, I think, 240 different markets. So every country is different, right? You know, all countries, you go to Southeast Asia, every market wants them to produce in their market. So we have a concept to produce with the CKD. So you go to China, and then they're really very good manufacturers who are very competitive on EV. So we have to localize and then design and produce with local suppliers in China for China. We just launched the Alexio, which is an EV model aiming at competing with the domestic manufacturers. Also, this car is going to be exported to other markets, for example, Australia. And then we like the competition. The competition makes us better.
At the same time, China deals with its own domestic demand issues, the economy in a slump. Is that what you're seeing in the market, or what potential is there?
Well, the most important for us is that while other manufacturers decided to abandon the Chinese market, we say we triple down. We are coming with new products. In the next couple of years, we're going to launch 3 new products. We have talked to our dealers recently in Shanghai. They welcome those products. But we need to be more competitive, and then we need to have local engineering. We need to have local suppliers, local technology, which in many cases is state of the art for those markets, right? For the Chinese market, we see a huge potential, and we are not here for the short term, but for the mid to long term.
We started this conversation with Hyundai and your focus on customers. Does it get you closer to the customer and to your clients by selling through Amazon?
Yes, absolutely. Well, there are way more customers that know Amazon than Hyundai. In fact, 90% of the customers who go to Amazon, they didn't know Hyundai. So through this project, I'm having a huge advantage. And therefore, I think it's a great project and allows us also to know better the shopping patterns and the interest that these customers have. But there is nothing like having a conversation with a customer when you visit a dealer to understand what they're thinking about your cars, your technology, and everything. I am constantly in contact with my dealers and my customers, and this is the way to go.
And then you get your Amazon reviews, don't you?
Absolutely.
José Muñoz here. Thank you so much for joining us. You're at the New Economy Forum, President and CEO at Hyundai Motor Company. Back to you, Paul.
Thank you for having me, Sherry.
All right. Thanks, Sherry. Just got some breaking news to get across. China's government has apparently issued a notice to halt imports of Japanese seafood. This is according to Kyodo. So the tension between Japan and China continuing to pile up. With that notice, China's government issuing a notice to halt Japan's seafood imports. Also an alert for you as well on the AI front. Elon Musk's artificial intelligence company xAI in advanced talks to raise $15 billion in new equity, and that would give a $230 billion valuation. This is according to people familiar with the plans. That new valuation would, of course, represent a pretty significant increase from the $113 billion that was disclosed after merging with Musk's social media site X. That was back in March. So plans to raise another $15 billion in new equity. There are no official comments from xAI, and Musk did deny a similar report on CNBC last week. But we do have more coming up from the New Economy Forum in Singapore. Haslinda's going to be back later this hour, hosting a panel discussion on AI's haves and have-nots with Google DeepMind COO and Singapore's Digital Development Minister. Much more ahead. This is Bloomberg. Let's get back now to Bloomberg NEF in Singapore with our next panel. Bloomberg's Timothy O'Brien moderating a discussion on the US government's shifting role on the world stage with former Commerce Secretary Gina Raimondo and Goldman Sachs President and COO John Waldron.
For some time. The other thing, which I believe, and not everyone agrees, the thing about the Trump administration and the people around the president and people in Congress who support him, they really believe in tariffs. In other words, it isn't just a convenient political thing that they've done, although it is good politics, particularly in the Midwest.
But it's part of the creed.
It is. They think Pax Americana was a ripoff. They think America has been, ripped off. They think
American workers have been ripped off.
American workers have been hurt. China and other countries have subsidized and taken advantage. And so I wouldn't be so glib. It's not just a political tool.
Mm-hmm. And do you think it's going to be difficult for future administrations to unwind some of this?
I really do. Now I have a specific viewpoint of this because I spent many hours in the Oval Office trying to convince President Biden to reduce some tariffs, particularly on inputs to things we want to manufacture in the U.S. And it was very hard to get that done because no one wants to be the American president accused of letting down the American worker. Right? Like, tariffs protect the American worker. I think AI makes it, more so of a political reality. You don't want to be the president that is responsible for President Biden used to say to me, I don't want to be responsible for losing a single American manufacturing job. I'm not lowering the tariff.
I think that's exacerbated in 26 if you believe that we're going to see a tougher labor environment.
Correct.
So it actually becomes politically more complicated. I agree.
If any of you have questions for John or Gina, they'll land on my iPad, and I'll try to get a couple of them in within the next 11 minutes and 30 seconds. John, the administration seems surprised by the rare earths flex, or at least maybe not ready for it. Were you surprised at how aggressive China was in that moment in terms of, sort of cracking the whip when they did and how they did it?
I'm not surprised because I think the Chinese have been preparing for, Trump 2.0 for quite some time. And I think that they knew that they had certain points of leverage that they would be deploying. And so, no, I'm not surprised at all. I'm not surprised that they thought that was a flashpoint of leverage that would allow for the conversations to be, perhaps more balanced. I think it's great that both sides determined to try to buy some, de-escalation.
To put their guns down.
Yeah, just to have a period of time where maybe cooler heads can prevail and we can start working on things around the margins where you can actually make the relationship better and stronger. Not being naive about the larger considerations that really haven't been solved and probably won't be solved.
That's what I was going to ask.
And I wouldn't have high hopes for 2026 being the year that those
kumbaya.
Those issues get resolved. But I think domestic politics on both sides are playing a role, and I think having a little bit of a détente is a good thing. And I think the presidents, the two leaders, are going to see each other, I think, quite a number of times in 2026. Either in G20 settings or in bilateral settings in the two countries. And I think that's a good thing to try to create more dialogue and more opportunity to find, some common ground in a relationship that's obviously going to be very complicated and is a real strategic rivalry. I think Pax Americana, to Gina's point, was America in a superpower position leading the world. And now I think there is a rival that is a strategic rival in many respects that is, America hasn't seen that.
Welcome back. You're watching Insight. So let's stick with AI themes, and the latest big tech tie-up has been announced. This one's between Microsoft and Nvidia. Let's get more with our Asia tech correspondent, Annabelle Jewellers. So, Annabelle, big deal here, $15 billion commitment to Anthropic, but at the same time, Anthropic's also making a multi-billion-dollar commitment to buy cloud services off Microsoft. So this is precisely what people get nervous about, isn't it?
Yeah, I think you've really hit the nail on the head, because it's not just $15 billion that Amazon or Microsoft rather and Nvidia are committing into Anthropic. It's what you say, Anthropic committing to buy $30 billion of compute power from AWS. And that's exactly what people are a little bit worried about, just yet another sign of a circular deal taking place in the AI space. But yes, what we understand is that overall, this certainly moves Anthropic closer to Microsoft. Anthropic is a company that was founded back in 2021 by former OpenAI employees. It is smaller in scale, but it has been having quite significant success in the enterprise space, but it brings it a lot closer into Microsoft's orbit. We do understand as well the investment should be part of Anthropic's next funding round. That part was actually on background, though. Sources speaking with us on the condition of anonymity. And then, to your point, Anthropic as well has committed to that purchase of $30 billion of compute power or compute capacity from Microsoft's Azure. So, yes, just another of these tie-ups that we're seeing.
Yeah, and tomorrow's just going to be such a huge day. The market's really holding their breath for these Nvidia results. What are we expecting, and what's the market reaction likely to be, regardless of what we hear?
Well, I think we know what the market reaction is likely to be. I think on the on the if you look on really the past several quarters. I mean, it doesn't really matter which number Nvidia produces. The reaction does tend to be to the downside. But going into these figures later today, you can see those estimates there. So we are expecting strong figures. I mean, growth in the data center business of 60% year on year. Nvidia, of course, is really at the center of the AI ecosystem, and you're likely to see that sort of sense still, but it is going to be really questionable, I guess. What does Jensen Huang say in this earnings call? We actually do have an interview coming up with him on Bloomberg Television as well, but is that going to be enough to assuage the fears of investors around the sustainability of the spending we're seeing? And again, going back to that share price performance, you can see there on average you get a drop in the following few weeks of around 2.7% in the stock price. Maybe we'll see something similar again, a bit of weakness after those numbers that are due later today.
Yeah, so likely a sell the fact tomorrow, concern over those circular deals that you mentioned a moment ago as well. And in this environment, we've got a downgrade from a major analyst for Microsoft and Amazon. Can you tell us a little bit more about that?
Yeah, this is an interesting one, actually, that came through from Redburn. So essentially what they've done is cut Amazon, also Microsoft, to neutral. This is an analyst that really doesn't actually have many stocks that he's targeting here, Alexander Hasel, but he has downgraded them for the first time since initiating coverage back in 2022. You can see from this chart here that Redburn is very much going against the grain, because most of the people or analysts that are tracking Microsoft, in fact, 97% of them, 94% of them for Amazon, continue to hold a buy rating. But I think what Redburn has done here is, again, going back to sort of the underlying economics of generative AI, and he's saying that they're far weaker than are assumed. And he's also worried about those depreciation schedules. That's something else we've been hearing from other investors in the market. And so most notably Michael Burry, of course, recently. But it is sort of, I guess, speaking to the tune of what has been that big concern on Wall Street generally around, again, whether we're in a bubble and is that spending sustainable. You can see there as well that reaction from the likes of Microsoft and Amazon, because you saw that slip in Amazon in particular during the session.
All right, Annabelle Drew is there with the latest on the AI front. Let's get to some more top stories that we're following. The US Senate is moving to clear a House-passed bill forcing the Justice Department to release its Jeffrey Epstein files. The House approved the measure 427-1, signaling strong bipartisan support despite President Trump's earlier opposition. Trump has since relented, though he could still delay the release of some documents as he orders new investigations into Epstein's ties to Democrats. President Trump says Saudi Arabia's Crown Prince Mohammed bin Salman knew nothing about the murder of Washington Post columnist Jamal Khashoggi. He made the comments as they met at the White House to announce a deepening of economic ties. A U.S. intelligence report released 4 years ago implicated the Crown Prince in the journalist's 2018 murder inside the Saudi consulate in Turkey. China has made its biggest daily purchase of US soybeans in 2 years, ending a pause and signaling support for last month's trade truce. The USDA says Beijing bought 792,000 tons on Tuesday, taking total purchases since October above 1 million tons. President Trump says he still wants China to speed up its buying, even as US soybeans trade at a premium to Brazil's crop. Mexican President Claudia Sheinbaum is ruling out any U.S. military intervention, pushing back on President Trump's suggestion he might deploy troops to fight drug smuggling. Sheinbaum says that Mexico will share intelligence, but it won't request foreign intervention. Trump's comments hit the peso after he said he may widen strikes on alleged drug trafficking vessels in the Caribbean and the Pacific. Okay, let's take a look at where Asian markets are standing at the moment. Just seen the Nikkei turn negative, and we did, of course, get the news a short time ago that China is now looking to ban imports of seafood products from Japan. That's according to the Kyodo news agency. The Nikkei, after a reasonably encouraging start, we're now off by about 1/5%. We did see a reasonably good JGB 20-year sale, meeting decent demand. That was viewed as a key test of investor appetite. The yen still very, very weak. But despite all the red you see on the screen there, it has been a better day for Asian stocks. The MSCI Asia Pacific Index did climb after 3 days of losses. We've also got the US 10-year holding pretty strongly, above 4% at the moment. But of course, as Spell was saying there, the markets are really holding their breath now for those Nvidia results. We will get those after the US close on Wednesday, and we will anticipate a likely sell the fact moment. Plenty more ahead. This is Bloomberg.
We're pleased to be making this progress, and it's only
Let's get
happening.
back now to the Bloomberg NEF in Singapore with our next panel getting underway. Insight anchor Haslinda Amin moderating a discussion on AI's haves and have-nots with Google DeepMind COO Lila Ibrahim and Singapore's Minister for Digital Development and Information, Josephine Teo.
Who really gets full access to AI?
Well, I think if you characterize it as AI haves and have-nots, very few countries in the world will be able to have all the elements of a AI ecosystem that are desirable, that are good. It's a given, it's a reality. I don't think it's going to change. But I also think we are not without agency. Within each of our own countries, we do have the ability to reshape things. And some of the areas that are worthwhile reshaping in order to be more ready for an AI future is investing in infrastructure, making it happen. You may not be able to do it on your own, but there are organizations like the World Bank, IMF, even the United Nations Development Program that are very alive to this problem and leaning forward to help. At the same time, you also want to think about creating the right conditions for the technology to be used in a responsible way. So at the right time, putting in place guardrails is something that every country can think about doing. But to my mind, the single most important area of intervention, of worthwhile effort, and where you must exercise the most agency is really in developing capabilities. And the capabilities have to be thought of in a holistic way. Capabilities in the workforce, capabilities in enterprises, capabilities within academia, actually even capabilities in AI governance and AI use within government itself. And different kinds of capabilities, entrepreneurial capabilities, engineering capabilities. There is, a whole range of things that need to be built up in order for a country to enable its citizens to benefit from AI and to have the best chance of moving ahead. Will you always get to what the next country is able to achieve? Maybe yes, maybe no, but that shouldn't hold us back from trying.
We can try, and it is about access. If you take a look at what we're hearing from the small and medium enterprises, 99% of the GDP in Singapore, economy, 70% of the workforce, they're saying that it's just too expensive. The rising cost of GPUs, cloud capacity, we know Google has taken that into consideration. How are you engaging with SMEs to counter the difficulties that they're going through?
Well, within Google DeepMind, we're the AI innovation engine for Google products. So one of the things that we really are working on with our colleagues across Google is how do we integrate our AI tools into existing programs. In some ways, I wish we could actually rebrand AI. If it's a good feature and it's actually being useful, it's just part of an everyday workflow. So the first step, I think, is actually getting it integrated and removing that barrier. But there is something about reducing the barrier of the literacy aspect. And part of this is, it's been quite amazing to see the past few years how many different resources are available in order to be able to use the technology. So one is just getting it integrated. The second is removing the barriers, as we talked about, in terms of just making the context window, which is the prompt window, larger so that you can input a lot of different information in a natural way. And then the other one is making sure that the users actually have the skill sets to do it.
Minister?
Well, I think SMEs are a very heterogeneous bunch, and there is no one single way of characterizing them. And in terms of their adoption, likewise, there will be different pathways. I'll tell you a story. It was quite, encouraging for me. This is a little hole in the wall along Killiney Road. They are a small eatery, and I happened to chance upon them one day, and I asked them how business was, and we ended up talking about AI. And they told me something quite unexpected. They said AI has been helping them do better business. I said, how? They said, well, I have to run promotions. And I've been running promotions in the past year. Some are more successful, some are less successful. And as it turns out, I now go to the platform, which has an AI assistant I can use, and I can ask it, based on my past sales record, to tell me which of my past promotions have been more successful. And that has helped me tremendously to plan the next promotion. The point of raising this example is to say that not every single SME is going to have to need its own access to GPUs. In this case, it's not even GPUs, it's just an app that was made available to this little eatery and an AI tool that was made available through it. There will be other SMEs where being able to use a fine-tuned model could be meaningful. If you take the fact that Singapore's GDP still has about 20% contributed by manufacturing, and many of these SMEs perhaps engaged in precision engineering work. We now have an AI Center of Excellence for manufacturing that has recently developed a common model that does predictive maintenance for CNC machines, which many of these SMEs will use. So the point I'm saying is that really there will be different methods of us being able to support the SMEs. Some will come through tools that are made available by bigger platforms. Some will be through efforts that are targeted at the sector, targeted at the kinds of companies in them. I think it's more important that we look at how we can make meaningful differences to how the way the businesses are operated.
It is still about leveling the playing field. And there are different options out there. If you take a look at China, it's open source. They say innovation is faster, it's cheaper, and then you have closed. How do you weigh the pros and cons of the two? We understand the concerns over data security, cyber breaches, but there are pros to an open system.
It's something that we have long history in actually making the technology available from the early days of the research into open source models, whether it's something we call Gemma or even AlphaFold for the scientific community to make it broadly available. We have 190 countries, over 3 million researchers using this to advance a number of fields, whether it's in food security, pollution, dealing with industrial waste, or even understanding diseases to advance therapeutics. And in many ways, that in and of itself is lowering barriers because now it's democratizing access to this information. But we also have to think about every case is different. So this balance of how can we seek the benefits while also managing the risks. And as the large language models and the multimodal models get more capable, this introduces a new level of risk. So when we released AlphaFold, our protein prediction model, we actually sought the outside expertise of scientists, academics, Nobel laureates in this space to say, what are the risks? We've assessed it this way. What do you think? What's the right way to deploy the technology? So it's kind of on a case-by-case basis. As AI gets more general and capable, this is something, though, that we're doing extra testing. So we've just released today Gemini 3, which is not only our state-of-the-art most advanced model, but also the most tested. And I think that's part of the pace of the technology right now because we still have issues with factuality, reasoning, understanding the context. These are things that are not going to be solved right away. So it's this balance of how do you make sure the technology is available so people can build off of it, they can advance their businesses, their economic opportunity, learning, et cetera, while still managing the risks.
I think if we are talking about widespread adoption, having access to open models are very important. And you think about the thousands and perhaps in time to come millions of applications that a very wide variety of organizations are going to have to use and individuals are going to have to use. Without access to open models, I think that would be quite problematic. On the other hand, if you're talking about a financial institution, if you're talking about an organization that has a lot of intellectual property or security concerns, expecting them to only rely on open models is clearly not going to be feasible. So I think the future will see a mix of these different kinds of access being made available, and we must do our part to try and ensure that access remains open as widely as possible if we want to see widespread adoption.
I'd like to touch on education, but before that, there is a poll. Would love for everybody to participate. The question is, how will AI most exacerbate global inequality? A, mass job displacement. B, concentration of power in a handful of companies and countries. C, insatiable demand for energy. And D, widening capability gap between advanced and developing economies. While you decide on your choice, let's talk about education. You know, Minister, we talk about how you must prepare the next generation. How are you thinking about the possibility of the elite institutions, the wealthy countries, being the next, I guess, source of AI talent? Is there a risk of that happening?
Well, there's definitely going to be competition to try and get as much of an advantage as possible in terms of raising the quality of human capital in each of our countries, and I don't think you can stop anyone from doing that. This sort of effort will take place with or without anyone, putting a stop to it or trying to boost it. I think what people can attempt to do is to ensure that they themselves have the ability to learn. And I think that in our education system, we do want to make sure that children have exposure at a young age, but in an appropriate way. The way AI is being used in our education system, I think, is being experimented upon. At one level, it was about enabling the teachers to be more productive, to be able to outsource, as it were, the more mundane aspects of their work, perhaps administrative work, to an AI assistant. That is not in and of itself harmful, but it also kind of misses the point of using AI for education. The great value of AI is in personalizing learning in a way that attends to the unique strengths and shortcomings of every learner, and trying to find ways to enable them to achieve better learning outcomes. So I'm very glad to say that my colleague, the Minister for Education, and I have had deep conversations about this, and our Ministry of Education is looking at it not just as a way to support teachers, but more as a way to support learning. And that is the direction I think we all should try and move towards. Now, is it something that every education system is able to do? I think we were just talking about this morning, the fact that Google DeepMind has set up a research lab in Singapore, and one of the potential areas for collaboration is identifying ways in which learning, education can be made more effective. And since we said in Singapore, AI for the public good for Singapore and the world, that being our vision, we hope that the benefits don't just accrue to students in Singapore, but potentially to students elsewhere.
And to that point, how do you cater to the underserved? I mean, you're an advocate for education and reskilling and skilling among such communities. What's your take on that?
Well, yeah, education is something that's really important to me, and just to comment on a few things there. I think that you have, in many ways, starting with teachers is good, the productivity. We're seeing around the world that teachers are really struggling to keep up with the workload as class sizes may get larger, as different skills may emerge within students. We just did a pilot, for example, in Northern Ireland, where with the government there, and 100 teachers for 6 months, and they found on average they reported 10 hours of savings per week per teacher. That's pretty significant. And what does that mean? It's not just about saving time, but it's actually letting the teacher do what they wanted to do in the first place, which is transfer their knowledge and passion for a topic to the students, which ultimately drives learning outcomes. So if we can come at this AI and learning from a different perspective, which is, yes, you have to start with the teachers, but the teachers are the magic in the classroom. So how do you actually free them up and then give them the tools to help with the learning outcomes, and also meet the learners with where they're at in their learning? We all learn differently. Whether you're a visual learner, you prefer to listen to podcasts to learn. So I think now that we have AI where it's, again, multimodal from the ground up, where you can now interact with the content in a different way. You can learn about physics by learning about your favorite sport and in the context, or instead of just giving an answer, being able to go multi-turn with the model. This is the type of technology that we think is really important. It all starts with treating learning like a first-class science problem, right? It's not just about physics or biology. It's like, which AI, at Google DeepMind we tend to focus on. It was actually investing in pedagogy and knowing that we come at it from an AI expertise. So who are the learning experts that we can go and talk with and make sure that our models and our AI development is grounded in this? We need to make the AI more factual. We need to make sure that it has the best of learning science built into it. But we also need to work with the community, because at the end of the day, this isn't about just layering AI on top of the existing education infrastructure. It's also rethinking about how are we going to train the next generation, and how are we going to ensure that they have this as a tool that they use responsibly. They're not just offloading